Good morning and welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. I hope you guys enjoy it with your morning coffee, as I am, at least in the preparation. Either way, you guys, thank you for joining me this morning. Really excited to go over a few things that's happening in the housing market. But first, I just want to apologize. I haven't done as many videos this month. I took a break at the beginning of this month, and I've been sick for the last about 2 to 3 days. I got sick when I did the video at the beach, probably from all of the bugs that I swallowed. My God, those bugs were awful, you guys. But I wanted to give you guys also an update on my investing. You guys know, some of you know that I kind of debanked a fair amount of my liquidity of my money, and I started investing it in treasury bills. So the really crazy thing, y'all, is we bought another bundle of 1 month treasury bills last Thursday. So only 1 month treasury bills last Thursday, and it was yielding 5.58% on 1 month. So right now, just from diverting our savings, my family household is making $200-300 a month just by putting our money in those treasury bills. So I just wanted to let you guys know that's a really good way to offset additional expenses, is by getting money back like that. Really, really cool stuff. I'm going to read an email here, from Elijah. There's Elijah right there. Good morning, everyone. Johnny, love you. Jeff, I love you guys so much, man. I'm in this with you guys. Kim, I am, everyone, Jeff, my man, Johnny. Y'all mean a lot to me. I think about you guys regularly, and I definitely read all your comments. You guys help me grow. I definitely appreciate that. So real quick, before I read Elijah's email, let me tell you guys what we're going to do today. So basically what it appears is going on right now is there's runaway inflation in our housing market right now. It appears right now there's runaway inflation, but I also want to remind you guys this. A lot of people are saying the crash is canceled, right? Even though we're still going through this journey. But let's not forget this. On the national average, okay, so we'll say national average, home prices are still not above where they peaked at last year. All we're seeing right now is a recovery, and I believe it's a dead cat bounce type of recovery where it's going to be kind of a whiplash downward. We'll go over those charts in a minute. But you guys, everyone's kind of caught up in, home prices are going up. And it is. Median sales price is going up, but not so much to where it has recovered from where we were at in the peak of last year. So I want to remind you guys of that. I'm going to do a market analysis as well. We're going to start with the market analysis because I really want to equip you guys on how to use a market analysis and how to instruct your realtor, because the market analysis is giving us data to understand, is it a good deal or not? And that's especially important when we go into new home build construction, because I've showed you guys that depending on the new home builder, depending on the community, a lot of those guys can deceive you, right? They can say there's $60,000 off listing price, but the reality is it's still 10% above market value. So again, I want to really start with the market analysis because I really want to drive that home, you guys. It's a really, really great way to equip yourself with the data. But after that, we're going to take a look at a couple videos on whether or not the Fed is going to pivot. Very interesting stuff. One is from Mortgage Stanley and one is from Moody Analytics. And they have opposing views on what they should do, what the Fed should do next. So it's actually a really cool video. Then we're going to go over two major red flags that I see and basically why. So the thing is I figured seasonality would come into play, right? And median sales price would rebound. I did not expect it to rebound so sharply, right? It's keeping pace almost with last year, which is, again, super shocking. To me, what that means is the economy is still red hot, more quantitative tightening, higher interest rates, but also the quantitative easing. We'll go over that. Now, after that, I'm going to jump into the Redfin Weekly update. And after I'm done with that Redfin article, I'm going to dig into, well, I promised James, I'm going to try to pull up Nashville stats, but I'm also going to go into like Austin, Boise, and places like that, just to remind you guys what's going on in those metro areas. Those metro areas are really easy to tell what's going on as far as the health of the housing market, as far as like decline in prices, increase of inventory. The hard places to kind of figure out what's going to happen next is like, the north, central, where home prices are still going up, like, certain areas in St. Louis, certain areas on the East Coast. That's going to be a little bit harder for us to call, whereas a lot of other places are easy, especially the further west you go. The further west you go, it's a lot more evident. But we'll jump into that, guys. And then I'm going to jump into some like really important details about the 1% down mortgage. So you've been probably hearing a lot about the 1% down mortgage. We're going to really dig into that. See, is it really a good deal? What do the guidelines say? And the reality is with that 1% mortgage, you guys, there's been better programs out already. Like right now, there's better programs out where it's actually 0 down. So, when all is said and done, there are some good things about the 1% down program. But in my opinion, that 1% down program, it's a marketing technique. It's designed to get people to call them. And I'll show you guys that. But again, you guys, let me start by Elijah. Where are you at, Elijah? I don't see you in the comments. What's going on? Don't move. Love you guys. I don't see Elijah, but Elijah sent me this email. Elijah wanted to basically, sound the alarm. So I'm going to read this email real quick. And this is a story about basically what happened with Elijah. And, it's basically going into the amount of money that he lost. So Elijah was actually flipping a property. Let me read this for you guys real quick. It says, "Hey, Travis, I wanted to share my experience with a flip gone wrong in Oregon on the West Coast." See what I mean about the West Coast? We purchased a place with an amazing mountain view and a large lot and speculated it would generate a huge return once refinished or refurnished. So they bought the house as a fixer-upper. They're going to put money into it, okay? So cost for materials and labor went up massively, causing repair costs to balloon. So in the middle of Elijah's project, everything got out of control as far as expenses. Now, we did about 80% of the work it needs. They fixed all the major issues, et cetera, et cetera. Now, the place was on the market the first week of January, and the realtor that they were using suggested that they listed their house for $625,000 back in January. The house sat on the market for over 100 days with only one serious buyer who backed out. All right. Now, since then, we've cut the price $100,000 over those months and just signed an offer at $475,000. So they went from $625,000 to $475,000. And then, basically he's saying he took a $35,000 loss. So basically he's probably warning you, be careful, right? Just be careful. It blindsided him. Things can blindside people, right? And when it comes to real estate, if you're blindsided in a real estate, it's hard to get out of that because it's a huge debt usually attached to that, right? Now, he also goes on, this is to Johnny. Johnny, this is from Elijah to you and really to everyone, but tell Johnny Fly to hold steady. A storm is coming. The lag effect for housing is catching up, and slowly investors are going to capitulate, at least in some areas in the U.S. If this spring buying demand ends and rates go up next month, I truly believe real estate is in trouble. So that's from Elijah, you guys. I just wanted to read that because he took the time to write it. Elijah, I appreciate you sending in that and sharing your story. So this is what we're going to do first. Let me switch to this camera real quick. So this is what we're going to do first, you guys. And I really want to, Johnny, where are you at? Why, Johnny, you don't feel attacked? Why, Johnny, you feel attacked? I love you, Johnny. That's Elijah. Okay, Johnny, feel attacked. Johnny, my last video I did, I wore your hat all video, Johnny. Johnny, you're one of the most loves, okay? But I am going to attack you because you're my friend. So friends should attack each other within reason to strengthen each other. Now, listen to me. I'm going to start this video out by digging into the market analysis. This is so important, you guys, that you use this data because and I hope I prove this to you, if you don't have the data, you're blind, okay? Now, the way you get a market analysis done is you have to be licensed. I have access to MLS, okay? And by being licensed, having access to the MLS, I can access sold home data, the actual sales price, not the listing price, but I can access and see what homes sold for at any given period of time, per se, right? Now, if you're not licensed and you don't have access to MLS, then you're going to need to probably reach out to a realtor to provide this information to you. If a realtor does not know how to do it, please, you guys, just reference this video and say, this is how you do it. I'm going to show you guys in about 5 minutes how to do a market analysis, okay? I just had to do the timestamp real quick. Cindy, where are you at, Cindy? But I had to do my timestamp. So again, this is so important, you guys, and this is so easy to do. So what I'm going to do is I'm going to do a quick market analysis on a new construction community called Tavola. So all I'm going to do, again, licensed agents, this is what you should be doing for your clients. Consumers, this is what you should be reviewing to understand if it's a good, great, bad, or what type of deal it is. So what I do is I only want to review sold property. I don't care about listings. I don't care about pending. I only want to review sold property. So all I'm going to do is just check that sold box right there. Now I'm going to put the date range of January to December of 2022. And what that allows me to do is review all of the properties that sold for 2022. Okay, so you guys see how easy this is? Look, okay, 2022, there's my date range. I'm putting my date range right there. Hopefully my audio is okay. I didn't adjust my audio. I had a little bit of issues. Okay, so there's the date range. So January to December. Now, here's how you really pin this down. Now, remember, you guys, real estate is so local. It's so local, you got to go to subdivision, okay? I talk about national trends so we can kind of see what's coming and things like that. But again, when it comes to you buying, you guys got to go local. So I set my parameters here of sold. Now, to go local, see this little thing here? It says subdivision. So this is designed to localize data in searches. So I'm going to type in the subdivision, which is Tavola, okay? And you guys can see, well, my picture's covering it, but I've set this up now. It literally, this is all it's taking. So now I'm going to do, and now there's 381 sold properties. I'm going to hit results down here. Now I'm going to check all these boxes, okay? Let me check all these boxes. I'm going to go down to stats down here, and I'm going to hit tabular. And y'all, that's how you do a market analysis. That's it. That's how easy it is to do. And you go back for several years if you want. And then you do the same thing with the rent. But this is it. It takes a couple minutes. But what's really important, we're going to use this data, and I'm going to access that subdivision live MLS data, and I'm going to show you guys what's happening in Tavola. But before we go into Tavola, before I show you Tavola, I got the timestamps. Before I show you Tavola, we first need to understand what homes we're selling for, and I'm using the year of 2022 to do that. So what I'm looking at first to start is my price per square foot. Okay, do y'all see that? This whole AI highlighter thing drives me crazy. But anyways, the price per square foot for 2022, and again, we're almost halfway through 2023. So you see what I'm saying? So I'm going all the way back to 2022. I'll go back further than that, but $149.34. But I also look at the average sales price. Okay, 330,000. Plus, I look at the average square footage of the house. Now, obviously, it could depend on the builder, but most of these builders, or most of the building in here is Lennar. But it would differ. So again, I equipped myself with the bare minimum. Do y'all understand? I want you to get familiar looking at this. This is a market analysis. This is what you need to be doing. If anyone asks me what's going on in a certain market, I'm always saying, what does your market analysis say? It took me a couple minutes. Y'all see? But now let's use this data to find the deal. So what do we know? We know $149.34 a square foot in 2022 on average. So now let me go back here. I'm going to show you guys this. This is so easy. Then I'm just going to check active listings because I only want to see active listings. I'm going to go back to the subdivision right here. I'm going to put in Tavola, which is the subdivision. I have 67 listings. Let me show you results. Take a look. And then what do I do next? I categorize the listings by price per square foot. Okay, whoops. I don't know what that happened there. All right, so here we go. What do we see? Okay, look at, so, and you guys may remember from some of my videos, Tavola is in trouble. So I actually reviewed like several new communities, and by far, Tavola is in the worst shape, you guys. It's in really bad shape. And we can see that now that we have the data, we can see that. So we know we're looking at what? 2022 value, which was $149 a square foot. Look at this. The first comp starts at $123 a square foot. I'm going to go back to that. But look at, we go all the way down and we see that we have 23 listings. We have a total of 23 listings that are under 2022 average price per square foot. We have 23 listings, y'all, out of what? 67? That represents 34% of those listings that are selling for under, you guys, and some of them well under 2022 values. And this is what I mean by using the data, right? Like I get people are going to buy, they're going to make their own decision as they should. But what I am saying at the bare minimum, use the data. At least know if you're getting a horrible deal, right? At least if you're going to buy a house, understand you're getting a horrible deal so you can prepare for it. But use this data. It is so important to use this, guys. Very, very important. Now look at the first listing. The first listing is only $123 a square foot. Sales price $275. And look at this. The square footage is the average, and it's really hard to do that. So the first one here, basically selling for what, $23 less than 2022. That first listing may be in the 2021 values or 2020 values, and it fits the average square footage, right? This is a good one. The first one's a good one. So you can click it. You can see it's a brand new house. It was just price cut. So they just lowered this by $3,000. Another thing I like to do, for when I represent clients, which I'm not doing now, I like to go to the property archive to see what they've been doing with the listings. Okay. This one was just recently listed, but again, this is ultimately what I'm saying here, guys, is this is what your realtor should be doing for you, right? This is what your realtor should be doing for you. Because your realtor's not buying the house, right? Y'all are the ones that are buying the house, not the realtor. Let me switch back to this camera. So it's y'all that need to see this data, all right? So I want you, again, this is what I would do if it's me. It's not personalized financial advice, but use the data. For the love of God, use the data. I get so many emails like, Travis, do you think this is a good deal? It's $50,000 off of listing price. There's no way to know if it's a good deal, if it's $50,000 off of listing price, without knowing what properties sold for throughout the years. It's impossible to do that. So anyways, you guys, that's that part. I'm going to go in. I'm going to hop into some videos real quick. I have to share my screen differently. Stop share. And we're going to go into this next part. Jason, what's up, brother? What's up, man? Jason, appreciate it, brother. Appreciate you, man. Hope you're doing well. I hope you're using the data, Jason. And Jason, this goes for everyone that's watching. I hope everyone that's watching is improving their purchasing power. So I hope, Jason, let me know you're improving your purchasing power and your knowledge in your local market. All right? Because whatever happens is going to happen in the future. We really can't control that. But we can control ourselves, right? We can control our own actions. That's all. So if you want to buy, but don't do it emotionally. I'm choosing not to buy. I've told you guys why I'm choosing, not to buy. But anyways, let's go back to the videos. I'm going to do another timestamp here. I think you guys will like the video. Again, I have to do it differently. Share screen volume here. It is. Let me do my timestamps real quick. Okay, we do some timestamps. So this first video, y'all, this first one's a doozy. This first video is Mortgage Stanley. So the second video is going to be by Moody Analytic. Okay. The surprising thing about these videos is I thought they would have the opposite stances, but they don't. So let's take a look at this. Let me know that the volume's okay if you guys can. I'm going to play it now.
Let's bring in Brian Weinstein. He's head of fixed income at Morgan Stanley Investment Management. And here on set with me is Chris Grisanti, chief equity strategist at MAI Capital Management. Welcome to both of you. Chris, I'll start with you. Why do they need to keep hiking?
Well, Kelly, I think the economy is still quite strong. It's an ocean liner. We've had an inverted curve for just about 6 months. It usually takes a year or more for things to really slow down. So they've really got their work cut out for them. There's still several hawks on the committee. I think you're going to see a hike in June.
Well, let me kind of ask it differently. Or sort of phrase it differently. Maybe everyone thinks they will hike, but should they? I mean, you're worried about a hard landing already here. I am. And having said that, I think the Fed's between a rock and a hard place because they can't be easy on inflation. If they by the way, the employment and the CPI numbers will come out right before the meeting. That might give them the excuse to hike that I think they're going to use. Or maybe the excuse to pause, or do you think or skip or whatever?
We're still going to see strength.
Okay. All right. Brian, I turn to you. And maybe only that really would explain bond yields at these levels, don't you think?
Yeah, I think that's right. I mean, as someone who thinks they should pause, and even Jay Powell was out, yesterday, or the day before, saying that there's some evidence they should pause. I think it's hard, right? I think the risk markets are saying they need to go, and I think the way they played the transitory card on inflation, too soon and maybe incorrectly, they need to show they're tough on inflation here. The market gives you an opening, you take it. I'm not sure they want to hike, but I do think another one is in the cards.
But so you basically said you actually don't think they should keep hiking, but just that they will. So what do you see that you're worried about?
I think there's a tale of two markets here, right? I mean, I think if you're a smaller business, if you're looking for a regional bank to lend to you, I think it's tough, right? I think credit conditions have gotten much tougher. You can see it in survey data. If you're a large company, it feels pretty good, I think, right? Especially a tech company. So I think the Fed, the evidence that they've pointed us to, CPI and employment, continues to move along in a way that suggests they need to hike, unless they point us another direction or the data changes dramatically in the next few weeks. You get another 25.
I mean, we'll wait for in a moment for the results of this auction. But Brian, are these yields a gift? I mean, who wouldn't? And Chris, I'll ask you as well. But okay, so you can get upwards of 5%. I think beyond the 6-month bill. I mean, maybe on the 1 year at this point. And I just don't understand why the market keeps offering what seem like such, kind of shockingly high, like a gift, like practically a gift for people to take.
Right. Well, Kelly, you and I have discussed this before. I mean, it's happening. Money is moving to the front end of the yield curve. Money market fund flows are great. People are buying T-bills, opening up Treasury direct accounts, or buying funds. And I think that's the right part of the curve. I think out the yield curve, where the market is really looking for the Fed to ease quickly, we're starting to struggle there, right? We got 10-year notes to 330, 335. They're back to 375, tight range. But actually, I think the market is questioning whether or not the Fed has to ease quickly. So it makes that cash market even more attractive in this environment. I think you'll keep seeing it. I do think it's a gift. I think it's a good place to invest money.
Yeah, I've been surprised by the strength in the 10-year part lately, almost 375 today.
All right, guys. So basically, they think that they should hike interest rates. And I mean, the economy is amazing. I mean, it's been resilient. I mean, what can we say? The data has shown us that, especially, and I'll show you guys in the data here in a minute, it's runaway inflation in the housing market. The inflation is almost, it's not, but it is almost keeping pace with last year. We haven't hit the peak, so it's still down from peak, but the recovery and the rally, I think right before a crash. I mean, it's a historical rally. To be honest with you, it's a historical rally going on right now. So very interesting to note that. I'm going to go into a second video, but before I do, let me come over here real quick. Jason, again, brother, you don't have to tip me, brother. Tip me. What am I talking about? Tipping. But I definitely appreciate you. This is what Jason's saying. Ignorance is bliss. It's a lot easier. That's why I keep trying to tell you guys, use the data. Use the data. Don't be ignorant, right? Use the data. And he's basically saying he's the opposite. And that makes it hard for me to buy as well, Jason. Like I have so many warning signs going off in my head and red flags going off, like every single day. I can't just blindly walk into a house. I know too much. So I think that's a great thing, man. I would rather know than not know. You know what I mean? And there was another comment by Nikki. Nikki, I wanted to bring this up real quick, okay? Vegas, I saw your comment. That was hilarious. I can't put it up, though. I can't put it up. I'm going to get sued by Lennar, man. Anyways, so this is Nikki, and this is something I want to talk about. Older homes in her area are as much as new builds now. Sellers aren't keeping up. That's important because in metro areas like in Texas, in my metro areas that have those abundance of new construction, which is a buyer's market, by the way, I would argue in some areas there's hyper supply with new construction in some areas. The fact that the new builds in her area and also in my area are starting to and continuing to go under resale averages, it's a good thing because that's going to lead the prices. New construction generally leads. So that's a good thing, Nikki. Hang in there. I have a, in my own personal market, y'all. Good morning, James. I see you, brother. In my own personal market, the inventory is trash. It's absolute trash right now. It's really quite sad. Brother, again, Jason, I appreciate you. Definitely appreciate you, man. I'm ready too. The thing is, as more time goes on, I'm just more and more prepared. You know what I mean? Like I have more money saved. Well, my credit is like the max, but I have more money saved. I have more qualifying income now. So I'm becoming even stronger, more frustrated. Yes, more frustrated, but I would rather be frustrated right now than be locked in to my house. All right. I've already learned that lesson. So we're going to jump into the other video again. Thank you guys for your patience. Let me know that the audio is okay here. This is interesting. This is from Zandy. And if you guys remember who Zandy is, Zandy was one of the only economists in the great financial collapse, the 2008 crisis. He was one of the only economic people that got it right. So Zandy is talking now, and I find it extremely interesting to hear what he has to say. Let's play it.
Next guest says the economy remains remarkably resilient. Joining us now is Moody's Analytics chief economist Mark Zandi. Mark, I feel like you've been calling for a Fed pause, disappointed in the last hike, and now, we've gotten a bunch of stronger data than expected. Does it make you rethink that position? Do you think they should be done?
Oh, they should be done. Yeah. I mean, Sarah, the key here is inflation. And in my view, inflation is coming in. Consumer price inflation peaked at 9%-ish back last summer. We're at 5%. I feel very confident. We can talk about why that inflation is going to be closer to 3 by the end of the year and back close to the Fed's target by this time next year. Obviously a lot of uncertainty around that, but I feel as confident in that forecast at the current rate of interest than I have in a long, long time. So and of course there's a lot of other things going on. Banking system still under a lot of stress. Economy's slowing. Recession risks are high. You add it all up. I don't think there's any need for another rate increase. Not now.
I think the market's been on board with that view, Mark, and then you just get some confusing data like what we got from the University of Michigan inflation expectations over the next 5 years jumping to 3.2%, the highest we've seen in a while.
Yeah, I don't put too much weight on the University of Michigan survey. I mean, it's a small survey, jumps around all over the place, and I'm not sure what to make of it. I mean, if I'm going to pick a confidence survey to look at, it would be the Conference Board Survey of Consumer Confidence, and that's rock solid, very close to its long-run average, hasn't budged. Feels like it's saying that the economy is in pretty good shape, but doesn't need another rate increase. And inflation expectations more broadly, they feel like they're coming in slowly but surely. I don't think it's a straight line. I mean, especially for consumers, it's going to take a while for them to truly believe that inflation is coming in because they've been through a lot over the past 3 years. So, but I wouldn't read too much into that University of Michigan survey.
Why are you so confident that the inflation rate is coming down to 3% when it's more than double where it should be on the target, and Fed officials don't seem as convinced as you do?
Yeah, 2 reasons. One is the cost of housing services, which is a very large share of the inflation pie, particularly in the consumer price index. That is, I feel this with a high degree of confidence, that is going to come in because we know that rents have gone flat to down in many parts of the country, a lot more supply hitting the market. There's still a record number of multifamily units in the pipeline going to completion, and they'll get completed. And demand is weak because of the previous surge in rents. So we have now demand destruction. Households can't form because they can't afford to buy a single family home or to rent. So that means lower rents, and that translates into lower cost of housing services over the next 12 months. And the other factor is vehicle prices. The really great news that came out of the last CPI report, Consumer Price Index report, was a decline in new vehicle prices. We've been waiting a long time for that. Finally getting enough production in Japan and Germany. Their supply chains are now finally getting back in order. They're producing more cars, and that means more cars on dealer lots, and that means weaker prices. And so that's the start of some consistent price declines here, I think, over the next 6-9 months. So, and that's another big part, a chunk of the pie, of the inflation pie. So those 2 things by themselves, Sarah, I think argue very, very strongly that inflation is going to come in here in a reasonably graceful way, at least through the end of the year into next.
Now, I'll tell you guys right now that it looks like rent is coming up, to be honest with you, in my own local housing market. And Houston is in one of the more crippled rent places. And I know I'm just looking at my local market, but if rent doesn't go down and it goes up, the Federal Reserve is going to have no choice but to continue to not only rate hike, but maybe 50 basis point rate hikes again. The runaway inflations in the housing market, I'll show you in the charts. It's pretty incredible. And I'm going to show you why I think that is, and why is no one taking the economic warning signs seriously. But Jason, appreciate you, brother. I see that you're retired. Let me switch cameras. I have to reset up my screen. I see you're a retired detective. I'll tell you one thing, brother. I need someone to walk these new construction development communities with me. I want to do a series, especially after that interview I did with those Lennar homeowners. I want to do a series where I'm going out to new communities and we're finding violations, like code violation, and also OSHA violation. The problem is, so if anyone knows what those look like, email me, because I don't have those eyes. I don't know exactly what to look for, but I would love to walk these, because something needs to change with these new home builders. I'm telling y'all, they're getting away with really shocking stuff. But this is Vegas. A preschooler can look at the current M2 money supply chart and see what's coming. Boom. Banks are going to collapse at an alarming rate. Vegas, they already have, brother. They have already collapsed at an alarming rate, but they propped it up. And so the thing is, I saw Jeff about Peter Schiff being right. Peter's been pretty spot on. But let's not forget, the federal government, Federal Reserve, stopped doing quantitative tightening. They started quantitative easing back at the end of February. $400 billion, at least, it's actually more now, but $400 billion of liquidity was pumped back into the market, to the banking sector. That's quantitative easing, you guys. So I didn't see the quantitative easing coming, okay? So that brings me to the next thing. Well, let's look at the Fed watch. Let me show you guys the Fed watch real quick. I think I got this set up pretty good now. All right, let's look at the Fed watch. This is a CME. Jeff knows this as well. Let me switch over here. This is really interesting. This is the likelihood of the rate hike. Okay, so I'm going to show you guys the likelihood of the rate hike. Here we go. This is pretty cool. This is, again, it's a CMA Fed watch tool. Pretty sure, I don't know. I think Jeff uses the same thing. But take a look, okay? This has changed drastically within the last month to even week. This is saying right here, y'all, that, and this is the market basically like anticipating as the Federal Reserve, when they meet in June, are they going to raise rates or are they going to pause? Okay, so it has shifted. It is now at 63%. You can see it here. 63% of people are now saying that they will increase rates by 25 basis points. I wonder if that's because of the runaway inflation and the fact that the quantitative easing that they just did probably didn't help their fight against inflation. In fact, I would argue the Fed is fighting themselves. The Fed is fighting themselves. Again, they did quantitative easing. I'm going to show you guys that in a minute. But I thought that was interesting because 1 month ago, it was only 23% of people. So 23% of people said rate hike. It's now changed to 63%. So huge changes right there, y'all. Huge changes right there. So what I want to do now, this is interesting. This is important. I want to show you guys two major things. All right, I'm going to show you guys two major things on, basically why I believe we're in the situation we're in now with the rebound, the seasonal like home buying rebound accelerating like it is. Again, I thought it would happen, but I did not think it would happen at this pace because I figured that consumers would not just dive into unaffordability in the way that has been going on. But take a look at this, guys. I think this is going to spell out a lot of the reason why we're seeing what we're seeing. All right. I'm going to go to the 1 year. This is the Fed balance sheet. This is what we can use to determine if they're really doing quantitative easing or quantitative tightening. Okay. So I want to point out that they stopped quantitative tightening the beginning of March and of February. Do y'all hear what I'm saying? Not only did they do that, look at this. It ballooned up. It peaked in March 2022, an extra roughly $400 billion. That puts us back all the way to October. Look at this, guys. October of 2022. Y'all hear what? So the quantitative easing that they did to bail out the banks put us back all the way. So we're reversing the space-time continuum now. We're reversing all of the progress now, all the way back to October of 2022. You can see that in that chart. Do y'all see that? So the quantitative easing, this balloon up right here, this is ballooning up. And I know that quantitative tightening can also be them not purchasing assets, but they purchase assets here. This is a massive injection of liquidity into the market. And this is what I'm saying. That's why I believe a part of the reason, at least, why we're seeing what we're seeing, there's such an accelerated rebound. That's why, in my opinion, we can't dispute that. That is a massive liquidity injection of, come on, guys. It's going to have an impact, $400 billion. And I also want to point out this. They're still not down to where quantitative tightening was when they started. They're at 8.4. The last, that takes us all the way back to February. So February 1st. So right now, as far as the quantitative tightening, we're at levels of about February 1st. But when it initially hit us, they injected, just to put this in perspective, the sheer amount of money that was injected, y'all, that put us back to October of 2022. That's a lot of money. All right. So what does this tell us? It tells us that they keep propping up the market. They keep kicking the can down the road. I think it's going to make it worse. Maybe they're geniuses, y'all. Maybe they're geniuses. We're going to hit a soft landing. Everything will be reset, and I'm wrong. Maybe that is what it is. But I don't think so. I think what they're doing is they're propping up the market, and they're just passing it. They're passing the buck. Maybe it's to wait for elections. I don't know. But I can tell you that massive skyrocket up here is not normal, and they weren't supposed to do that. They weren't supposed to do that. 1 week before they did that, Jerome Powell went to Congress and he said, we have horrible inflation. We need higher rates for longer. This is horrible. 1 week later, look at what they did. 1 week later. That has an impact, y'all. That has an impact. Don't forget that. Here's the other thing. All right? Here's the other thing. A lot of people, oh, we're out of the woods. We're not out of the woods. We're still in the cycle. We're still in the cycle. You guys, here's what we have on our side. All right? Here's what we have on our side. If you're more bearish like me, you want prices to correct. The people that are, the realtors and the over optimistic people, they can't take away from the fact that the inversion of the yields. This is saying we probably haven't even gone through a recession yet. That is so crazy to me to think about that. And again, I think we haven't gone through the recession yet because they just they liquidated $400 billion. 400. Okay? But anyways, we're still inverted, you guys. Look at it. We're still inverted. This is one of the major economic signals of incoming pain. This right here. All right? And this is just the 10 and the 2 year. I could go 3 months, I'll go 6. I'll show all kinds of reasons why historically we are guaranteed a recession historically. And if we don't have a recession, if we don't have more pain, then this will be the first time in history that we don't go into a recession with inversions like this. And the depth of this inversion we haven't hit since 1981. The depth of the inversion, 1981. Think about all these things. So let me ask you guys this question. Do you think people are better spenders now than they were in 1981? Are people more responsible today than they were in 1981? I don't think so. I think people are way worse spenders than they were last time. I think this is all a bunch of smoke and mirrors, quite frankly. Now, I don't like it. We're still going to go by the data. I'm just sharing my opinion. There's the bears, there's the bulls, and there's something in between. I'm always going to be a little bit bearish, especially with real estate, because I paid the price, and I believe that's what we owe as professionals to consumers. I'm in charge of helping consumers find a house. I believe that in that process, agents and realtors should be warning potential buyers. Okay? Again, unaffordability. Huge price up. We still have an inversion in the yields, which means we haven't even gone through a recession. We haven't even gone through the unemployment. Those are huge factors, you guys. Huge factors. We're going to go into interest rates here in a minute. Let me pull this up. I got a super chat, brother. Don't move from Texas. Please don't boots on the ground without a lawyer and a bodyguard. You guys know he's referring to, because the one Lennar community I went to, the dude was threatening to call the cops. He was trying to like strong arm me and bully me. And then the guy calls unrelated to my employer, completely unrelated. He knows that. He calls trying to get, from the sound of it, trying to get me fired. How could Lennar get it? Anyways, so that's what he's saying. You want to come with me? Don't move. Come with me, man. Be my bodyguard and my lawyer. If you're a lawyer, dude, let's go, dude. Let's go. It's no joke out there, you guys. I don't like the drama. I don't like the drama at all. Okay, this is from Jason. Let me know if you want to walk. I have an eye for this stuff, not my profession, but I know stuff and I can become proficient. I have time. And I will, man. Email me and tell me the area that you're in. I think you said Houston, but tell me what area, okay? And dude, stop giving me live chats. Thank you, brother. Thank you. I appreciate that tremendously. Let's look at interest rates. Let's take a look at interest rates. Now, remember, we were, through Memorial Day at 7.1, but yesterday the 10-year plummeted. It plummeted. So let me show you guys what rates dropped to. Let me do my timestamp. Okay, sorry for the lag. Let me show you guys. And I still feel a little sick. I'm sorry. Okay, take a look at this. Let's see here. Okay. So I was reading a comment. See how that arrow is doing that? I hate that. I can't do that. I have to go back here. I have to do this differently. I can't do this with those arrows doing that, you guys. I have to do something special. It's a StreamYard problem. All right. So interest rates right now are sitting at 6.95%. That's how we ended yesterday. That was following a massive decline of the 10-year. And the 10-year had a massive decline because the news broke that debt ceiling deal had been reached. So that plummeted. the opposite direction. It actually went down, right? We don't want it to go down. We want it to go up to curve the buying demand. But right now it's sitting at 6.95. All right. So let's see what the 10-year is at today. Okay, look at this. So as of right now, the 10-year is down roughly 3 basis points, which will probably mean as long as it stays down 3 basis points, it's probably going to reduce interest rates. So my guess is, and I've been really accurate at this, I'm going to probably say we're going to end, we'll end this. Oh my gosh, 666. That's horrible. All right, enough of that. That's the devil's sign right there. I don't want you guys to see that. I mean, you're grown adults, make up your own mind. But anyways, I think it's going to end at probably 6.83. I don't know. We'll see. Probably like 6.8 something is what I'm thinking. Let's see what it's at now. Okay, good. 664. Okay. So this is what I'm going to do now, you guys. I'm going to go over the Redfin Weekly. Okay. We're going to go over the Redfin Weekly, and this is what I'm going to do. I'm going to read like 3 paragraphs of this. Throat hurts. We're going to go over leading indicators, a couple things like that. We'll go over the charts. Now, after that, I'm going to access Nashville. James, I saw you on there. I'm going to access Nashville, but I'm also going to access like some of the major metro areas that were experiencing massive price crashing, and we're going to see the status of their inventory and the median sales price. All right, so we're going to look at median sales price and inventory for a few metros after I read this, okay? So let me put my timestamp. It's going to hurt me to read this, y'all. I can already feel it in my throat. All right, let's see here. All right, I'm going to throw this up. All right. So here's the weekly update. There'll be another weekly update probably the end of the day tomorrow, maybe Friday. I'll go over that with you again. I would have been more prompt on this, guys. Again, I've been kind of a little bit bedridden. Now, potential sellers continued. This is the analysis. Okay, so this is a weekly update from Redfin about the housing market. Potential sellers continued backing off, with new listings of homes for sale dropping 24%. That sucks. One of the biggest declines since May 2020. That's because homeowners continue to hang on to their homes locked in by competitively low rates. Even though demand is down, it's still outpacing supply, as the new listing drought has caused the total number of homes for sale to post an annual decline of 0.9% for the first time in nearly a year. Really important to understand, that's not new construction. This is overall. New construction is flourishing. New construction is absolutely flourishing. Remember, I showed you Tovola. Over 30% of the listings in Tovola are listed, some for well under, but 36% under 2022 median average. That's a big deal. That is a big deal. Let's not forget, okay? Now, despite rates jumping 7% and lack of new listings, many early stage home buyers remain committed. Okay, home buying demand, Redfin's home buying demand index, which measures requests for tours and other services of Redfin agents, increased this week to negative 1% from a year earlier. That's crazy. If you really think about what that is saying, that's crazy. That means that it is possible that inflation in the housing market exceeds the inflation of last year, right after a deflationary period in a cycle that's not finished. It's really crazy, you guys. The cycle's not finished, first of all. That's why people like Travis, do you still think the housing market's going to crash? I don't see how you can say that. That's what they tell me. And I'm like, y'all, it's not done. It's not done. It's not done. Stop jumping the gun. Anyways, people may be wondering why rates are surging as we come against a potential debt crisis. Right now, the way investors are reacting is the driving force. Mortgage rates have increased over the past 2 weeks because it looks more likely that the U.S. government will avoid hitting a debt ceiling. So basically, like I said, they went up because of that debt ceiling. Now look at these leading indicators. Mortgage rates, daily average 7.01. They're using 6.57. So they're using low rates for their calculations. Also, here's the telling sign. Even though people are like, they're saying demand is only 1% down, that's nonsense. Demand has always been there, first of all. Mortgage applications is an important data set to follow. Mortgage applications is down 30%. which tells us if we had the inventory, total disaster in the housing market right now. If we had the hyper supply like last time, total disaster. Total disaster. Anyways, we'll look at inventory here in a minute. Now, Google searches down only 13%. Really astonishing. Take a look at this. This is what I do not like. The median sales price, $375,000, and then it goes on to say down 2.2%. That's what I'm saying. All these people saying, oh, you guys, Dave Ramsey did a video yesterday. I'm going to do a response video. Dave Ramsey's like, I told you so. And he said that. Dave Ramsey, I told you so. Prices never went down. And I'm thinking to myself, bro, like you are a psychopath that can't see past your nose. Prices went down all over the place. You were wrong, brother. You said prices never go down. You also said rent never goes down since Jesus was born. You said that. Anyways, prices are still down on a national average. Case-Shiller's different. Down from peak year over year. It's not on Case-Shiller, but down 2.2%. So we haven't even rebounded yet. What you're seeing here is the prices try to recover. They have not gone up from peak, right? That's what I'm saying, from peak. Jason, I see you. Thank you, brother. Love you guys. Threw me off. Brother, stop, dude. I appreciate you, man. Can travel to all 5 counties. I love you. I'm close to Cypress, actually. A lot of new building out in that area. Sorry for that, guys. So Austin's down 18.3%. So that's my definition of a crash is 15 from peak. Austin's crashing. Oakland's crashing. Las Vegas rebounded. San Jose's not on there. San Francisco's at 10. Sacktown at 8.8. Pretty much all of those have rebounded except what? Austin. The reason why Austin hasn't rebounded, and I'll show you here in a minute, is because they have more inventory than any of those other metro areas. Austin. That's why Austin, you're not seeing a giant rebound in Austin. You're seeing a continuation of like declining. It's really a plateau, but it's because unlike San Jose and Oakland, they have an abundance of inventory in Austin. Unfortunately, it's primarily new construction, which is complete garbage in my opinion. So that's that. I'm going to go into the charts with you guys now. I'm going to move over, darn it, to this camera. Okay. Now we're going to go over the charts. We're going to go over the charts. I want to show you this. I'm going to show you guys this, okay? Let me see. How do I want to do this? I guess I'll just do like this. I'm going to put my little picture. Just put my little picture right here. All right. Okay. We're visualizing the data. We're visualizing the data, and I want to show you guys this. Now, I've made 2 black lines here. Okay. Jason, thank you, brother. Thank you. I appreciate it. I know. But the thing is, man, I'm preaching for people to save their money. That's why I say that. I'm preaching for people to save their money. Take a look at this. I've drawn those black lines right there because that's when I believe in that pocket, we're going to see that whiplash downward in median sales price. But we are up week over week, even though this is saying, I have to turn my pen on. I'm so sorry. Even though this is saying, okay, down 2.2% year over year, that's only measuring this from this orange line to this red line right here. That's what that's measuring. It's down from this time last year, 2.2%. Okay, that's cool, right? No, that's not cool. It should be down way more than that because look at guys, look at the trajectory. All right, let me show you. Let me get that off of there. Look at this trajectory. This trajectory, okay, is keeping a similar pace as it is last year. In fact, it could possibly get even worse. Let me zoom in. Look at the week over week trajectory right there. Look at that. It's possible that we, as hard as this is to believe, we may go over 2022 briefly. Look at how close we are and look at the trajectory. If they don't do something, you guys, if the Federal Reserve doesn't do something and they don't keep rates high, if they pivot, if they keep doing quantitative easing, we are so done. No one's going to be able to afford a house. All of the fundamentals are completely gone. Completely new era in our entire world. What happened? All right. That's crazy. Now, that is crazy. Now, I've been preaching to you guys that I believe at the end of June is when that whiplash is going to happen. Okay. The reason I drew this line here, that first black line, is when July starts. So I think that we're going to have this whole period right here where I'm circling, where possibly median sales price continues to go up. If it crosses that red line, y'all, oh my God, if it crosses that red line. But again, once we hit after June, I think it's going to go down. That's what happened last year if you look at that red line. Now, if we look at both the blue line and the gray line, which represents 2020, 2021, you can see that home values start to either decline or plateau in September. So that's why I drew this line here. So in between those two black lines is basically July to September, which is what I'm saying. Median sales price is going to go down, and it's going to go down swiftly. That's what I'm saying. That's what I'm hypothesizing, at least. All right. So anyways, that's median sales price. Very interesting to note. Janet, appreciate you. Got some new members. Welcome, Janet. Appreciate y'all. Take a look at this next chart. Okay. This is Johnny's chart. This is Johnny's chart. This is median asking price. Median asking price leads median sales price. Y'all, insane. Median asking price. Look at how close it is to being to going over the peak of 2022. Even though homes right now, it's so much more unaffordable. There's so many warning signs now. This may go over. This may go over 2022. Look at how close it is. Is that not shocking? Y'all, this is what I really feel sad for anyone that's buying right now. I'm a lot more bearish in this market. I don't feel bad for people that are actually using the data and finding a great deal and like house hacking, right? Like, good job, guys, because it's really hard to do that right now. I'm talking about the people that are emotionally buying, and y'all know as well as I do that's happening. That's 100% happening. Y'all know that. I feel sorry for these guys, man. For the last 2 years of people buying, I feel sorry for them. It sucks that they couldn't wait. Look at this is one of the reasons why. Look at that. Remember I said the last update video that would like skyrocket week to week? It did. It skyrocketed up. The average payment, and this is at the lower interest rate. If we use the higher interest rate, today's interest rate, scrog. All right. If we use the higher interest rate, the payment's going to be higher. But right now, the average mortgage payment, record high, $2,614. $2,600, and the inflation is keeping up with that. This is, man, everyone with those 2% rates, pat yourself on the back, y'all. It's the home ownership post 2022 completely different than after 2022. It's not even the same. Owning a home post 2022, yikes. Before 2022, you may have made out well. But my gosh, especially if you purchased in 2020, you purchased in 2021, you're going to be doing the best. You purchased in 2021, look at, they're way down here. Look at that, way down there. You purchased recently, doomsday. Anyways, sorry for all that. That was a little bit of emotional outburst. Crazy. Look at this. Starting to decline. It's not enough data to say there's a trend, but going down. Okay, week over week, pending sales going down. This is what we want up. Okay, this is the new listings. So new listings year over year is down 24%. That's horrible. That's horrible. We want more. We want more listings than that. But I want to point out it's above 2020. So at least it's above 2020, right? It's above 2020, but that's pretty low. 24% year over year. And that's like, we can actually say year over year is down 24% year over year, right? Because the blue and the red line. So, wow. But it is going up. So that is good. So it's going up. It'll probably keep going up again to probably August. So when it starts going down normally is about right here, which is August. So we'll see. Average listings of homes for sale. Okay, I don't really care about that. This is what I do care about a lot. We should all be caring about this. This is a month of supply, okay, available on the market. It has been plateauing. This is good, okay? But what's bad here is it's not gone up. And it hasn't gone up since the beginning of the year. So the last time it's gone up, right here. That sucks. That sucks, y'all. And I find it funny that that's around the time right here when the quantitative easing started. That's the quantitative easing where that black line is, by the way. But we have 2.6 months of inventory right now. Obviously, we want 6 months, right? We have over 7 months of new construction, but overall, the resale market is absolute garbage right now. Absolute garbage. I really feel bad for people that are frustrated in areas like Jeff a little bit, where they don't have a whole bunch of new construction. Like I have a whole bunch of new construction, so I'm doing good. I can see things a lot more clearly in my metro area where there's heavy new construction. I mean, literally, there's hundreds of houses for sale around my local housing market, but that's new construction. Resale is still a little bit garbage. Let's see, what else do we want to go over? Okay, 34% of homes sold for above final list price. Now that's down over the last 2 years, but it is over 2022. Okay, so it's over here. We want it under 2022. I'm sorry, 2020. That's over 2020. It's under 2021 and 2022, but still, the fact that 1/3 of houses are selling above their list price, you know, what that can demonstrate is like the new listings that are coming on the market that are favorable. Like no one's buying the crap listings that have been sitting on the market for like 90 to 100 days. But people, as soon as a nice one comes up, you got all these buyers that are scooping into the same house, the real nice house, scooping in, driving those prices up. Horrible thing to do. My opinion. It's just my opinion. Let's keep going. Oh my gosh. This one's good. See, I put that star right there. This one's good. This one's good. What leads median asking price? Listings that had price drops. Okay. This has been going up. Okay. But remember, it's a lag. This has been going up, what, for a month? This is good. So you would think it's going to start showing in the median asking price, but it hasn't really. It hasn't really shown that in the median asking price or the median sales price. But that's generally where it starts. It's really the best indicator to see if the interest rates are impacting listings. It's going up, which again, just the dynamic in this market, you guys, is absolutely mind-blowing. It's so split down the middle. And usually when something's split down the middle and like bad things are happening, usually that's a sign that bad things are going to come for the people that are okay, right? There's a storm over here that's spreading across the nation. I think it's important to understand it. Okay, let's see. This is crazy. Look at this. This is home buying demand. I circled this because we are at a pivotal moment right now, you guys. We are at such a, like, what happens in the next month, I think it's going to be like, my God, it's going to be important. What the Fed does and what consumers do, and like any systematic failure, whatever happens, it needs to happen the next month. Because if it doesn't, then I think we're going to have a runaway inflation once again in the housing market, which is not necessarily a bad thing because that means that the Federal Reserve will punish us even more, which is kind of what we want. But look at that. Demand is almost exceeding now 2020 and 2022. Isn't that crazy to you guys? It's not. It hasn't crossed it yet. It hasn't crossed last year, but look at how close that is. That's crazy, you guys. That's absolutely crazy. I hate this data. I do not like it, and I fear for the people. I fear for these people. All right. Now, that was Redfin. So we'll keep watching. Now, remember what I showed you guys, the quantitative easing that's happening? Remember, I also showed you the quantitative easing. What else did I show you? Oh, my gosh, you guys. The inversion. The inversion of the yields. So now let's go over, let me switch my cams. Let's go over this new 1% down payment loan. Okay. We're going to go over that now because I'm telling you guys right now, I'm just going to tell you up front, there's some decent things about it, but it's really designed to get them to get you guys to call them. It's a marketing ploy. I used to deal with this all the time when I was like originating like super duper hard, and then I got to go into the metros, but I just want to show you this. Okay. So this is a conventional mortgage. So this is the 1% down. See this by Rocket Mortgage. So 1% down by Rocket Mortgage. Here's the thing. There's grants right now that will have you pay 0% down. This is not new. There's actually a little bit of new, but there's always been grants available is my point. Okay. So there's always been grants available. And what this is it's basically a, home possible or home ready conventional mortgage, which only requires someone to put 3% down. What Rocket Mortgage is doing is they're taking a grant that offers 2% and they're paying that 2% to the down payment. The thing is there's grants that have 4 and 5%. So my question is why are they using the grant with only 2%? I'm just saying. There's even better grants than what they're saying. And they've been here the whole time. They've just pushed this marketing ploy for the market share to get their phone to ring. It's really easy to see that. But it's interesting. It's a 2% grant. Okay, that's it. So all this is, it's a 2% grant on top of a Home Possible program. That's all this is. And in fact, you can get a better program. You get a Home Possible program with a 4 or 5% grant in Texas. It's called Southeastern Texas Housing, or that's Seth, and there's another one, T-Shack. In Texas, T-Shack and Seth, it's more than 2%. The problem with these loans are, you guys, is generally the interest rate is much higher. Let me show you guys something. This is highlighted this because this is available for both first-time and repeat home buyers. That's pretty surprising to me. Now, I do like this part. And this comes with home, I can't remember if it's Home Possible or Home Ready. They have a deduction of mortgage insurance. So if anyone's purchasing with the minimum down payment that's getting a conventional, I would probably ask my loan officer if I qualify for Home Possible or Home Ready, not only because you only have to put 3% down, but also because your mortgage insurance is lower. Now, I want to make a point here. This is a conventional mortgage. Generally, the people that are getting grants have bad credit. You can't get generally, I'm not an underwriter, you can't get a conventional mortgage if you have bad credit and if you're getting a grant. If you get a grant, that's an even worse LLPA adjustment or price adjustment. Now, here's how you qualify. I'll show you what I was talking about here in a minute. This is income-driven qualification, okay? So on top of like having to qualify for conventional, which is, we'll say with this criteria, a maximum of 45% DTI because there's no compensating factor of reserves here. You're using someone else's money to buy the house. You can't make more than 80% of the median income. So if your household, that's household, okay? If your household makes more than 80% of the average income, you don't even qualify. You don't even qualify. I don't qualify for this. But to give you an example, so in Michigan, Macomb County, Michigan, median this is crazy. This is that high, but average income is $90,000. You got to take 80% of that, all right, which is right here. $72,000. Let me show you guys how this works. Okay. I'm going to show you this right now. This is how you figure out what you qualify for. So I'm going to take that $72,640. And the reason I'm showing you guys this is because most people aren't going to qualify for this program. It's, again, they want people to call them. Hey, da, da, da. And you'll find, I'm telling you now, the rate's going to be higher if you use the grant. But taking conventional mortgage, we're going to say the maximum DTI is 45% because if you use the grant, you're going to lose compensating factors. It can go up to 50, but we're going to say 45 because realistically, the max DTI for this type of borrower is 45. So you go times 0.45. Okay. I'm sorry. I first have to do this, guys. I'm going to break it down to monthly, just so it's easier for you guys to follow along. So I'm going to do this again. So that's the 80% right there. I'm going to divide this into monthly for a monthly payment. Okay. Then I'm going to multiply this by 0.45. So that's the amount of money that I can use for my loan. Oh, you guys, my calculator's not coming up. My gosh. See, I hate this. But anyways, you guys can't even see what I'm doing right now. Okay. Well, anyways, how do I show you what I'm doing? So what I was trying to do is, I'm going to try this. I'm going to try something real quick. I can't believe you guys I just missed all that. That was like a really important part too. That was really going to make a good point with this. I have to set up my screen again. Something's wrong with StreamYard. All right, here we go. All right. Okay. So let's do this again for the third time. So I'm going to take the qualifying income. Okay. We're going to divide it by 12 to break it down to monthly. Then I'm going to, because maximum DTI is 45%. That means the maximum amount of my income that goes to paying off bills and the mortgage, right, is qualified, is what we're going to use. So I'm going to multiply this by 45. Look, okay. So 45%. DTI is maximum 45%. That means that my qualifying, or the income that I can use to pay bills, cannot exceed $2,724. Do y'all follow me? So if my mortgage payment and my debt exceeds that number, I don't qualify. But remember, we have to take out car payments and credit cards, right? So let's take out a car payment. I'm not going to use $1,000. I should, but I'm only going to say their car payment is $650. So I subtract $650 because it's $650 monthly car payment. That gives me income I can use of $2,074. But what does the other debt people have right now? I'm not talking about school loans, credit cards. So let's subtract $150 in monthly payments on credit cards. Raise your hand if anyone that's listening probably has more debt than I just mentioned. But I want to make a point. After my debt, that means my mortgage payment cannot exceed $1,924. Okay? So $1,924. Now I want to show you guys this. Dang it. Screen share is just shucks. It just shucks. I'm going to do mortgage payment. Okay. Present. I am so sorry. This a little bit of technical difficulties. All right. Take a look. Now, let's put 300,000. Okay. So 300,000. I'm going to include taxes and insurance. Boom, 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 boom. This all looks good. Okay. So my payment cannot be above 1924. Let's see how much of a house. It's only 5% down. Let's see how much of a house I can purchase. So I'm going to change that to, it's actually 3% down. So 3% down. I'm going to lower the mortgage insurance by half as if you would qualify for the program. So look at this. Let's see what we can qualify for. Okay. Can we qualify for a $300,000 house? No. Because this payment exceeds 1924. So normal people can't even, by doing that loan, because remember, you can't make too much money. By doing that loan, most people can't even qualify for 300,000. Let's keep going. Can we go 250? For sure we could do 250, right? Look at that. Even a $250,000 house exceeds $1,924 by a lot. Y'all see my point here? Let's go down all the way to 200,000. Where do they sell $200,000 houses at? I don't know. Look at that. 200,000. So, come on, right? 200,000. Are you for real? Well, what's the median sales price in that county? It's right here. I already have it. Boom. 240. So they can only qualify on average from the calculations that I made for $200,000, yet the median sales price is 240. That's why I'm trying to tell you guys it's a joke. Okay. It is a program that, I think that some people should look into depending on how much higher the interest rate is. But most people aren't going to qualify for it. And just to put this in perspective, let me show you their interest rates. Let me show you guys these interest rates. You guys are going to freak. Look at this. Take a look at this. They don't tell you this. Look at the average rate. Okay. I'm on Rocket Mortgage again. This is crazy. Okay. I love it. I love mortgage and loan stuff. I love reading charts like this. This is a 30-year fixed mortgage. They're saying right now today, Rocket Mortgage, and this is not with the 1% program, by the way. With the 1% program, it's probably going to be more, but the rate that they're quoting is 7.125. But pay attention, you guys. What's this number? What's this right here? What can this be? Okay, look at this. In order to get that rate, it costs 2 points. So, yeah, maybe they're helping you with 2% with the down payment, but you still got to pay 2 points up front. What is it really doing? You're just washing the fee. You guys, you see that? There's 2 points. They said they're going to pay 2% towards down payment. Look at the points. There's 2 points here. That's your LLPAs. That's what that good credit tax is right there. It's your points. It's your LLPAs. So I can almost guarantee you, I don't want to speak on their behalf, that when they add the LLPA for the grant program, that's going to shoot up. So what I'm trying to say is a lot of times it makes more sense not to get that special down payment program, because by doing that generally, okay, you're paying more interest over time. You don't want to pay less. You want to pay more down payment, right? You want to pay 10%, 15%. You don't want to pay an outrageous amount of interest. And when people go and they get these grants and they get these down payment assistance programs, generally they're going to be paying a lot more for their mortgage. So just FYI on that. It's usually the only purpose of those programs is to help offset the initial expense of moving in. That's it. It's not for payments. It's going to be higher. Again, depending on Home Possible or Home Ready, there's some special stuff there. But let me go in now to the metro areas, and we'll finish this. Okay, I want to timestamp this. Man, my voice is killing me, you guys. This has been a long live. All right. Y'all take a look. I want to show you some metro areas. All right, let's go now. Remember where you go? You guys could do this yourself. I'm going to go to the data center. Okay. I'm gonna show you guys some stuff. First, let me see if Nashville's on here for James. Yeah. All right, let's look at Nashville. I'm only gonna look at median sales price and months of supply. Okay, so let's go to median sales price. This is Nashville. Oh, okay, so all right. Nashville went on the year-over-year price decline list in March of this year. Okay, so it's pretty sideways. So we started the year at median sale of 446. We're now at 445. So you guys, our price is going up or down in Nashville? Our price is going up in Nashville or down? On average, they're going down. So again, the narrative that everything is going up, it's not. Some metro areas it is, a lot of them it is, but a lot of them it's not. And that, remember, flipped. When did it flip? After the quantitative easing. But look at that, you guys. From here to here, it's down $1,000, and it's down from here to here 6%. That's crazy. I didn't realize Nashville was down. So James, Nashville is still down 6% year over year, and pretty much it's remained pretty sideways this entire year. So when it starts to slow down between July and September, it's probably going to get crushed, quite frankly. So if I'm in Nashville, well, pretty much this is what we've learned, okay? Generally, the best time to buy is between December and February. So if I'm in Nashville, I'm like, oh, this is looking good. I'm going to probably buy anywhere between December and February. I'm not saying this December or February, but that normally that pocket, right? Let's look at inventory. Months of supply. Wow. Okay. So this is good. See, this is really good. This is really good. This is really, really good because it's showing that we don't want, yes, inventory did drop. Okay, so it skyrocketed up, started dropping at the end of January. Look at, but instead of dropping more, like in many metro areas, it remains sideways. That's really good. That's really good because when the cycle, the seasonality, when it reverses, which it does every year with or without quantitative tightening, it reverses every single year. They're going to get crushed. Their inventory and supply is going to shoot up, and their median sales price is going to come down because look at the supply. It is exceeding the last 2 years significantly, but it's still low. It's at 3 months and change. It's like 3.2 months, if I'm doing the math correctly in my head. So it's still low, but again, we're still at the hot end of the cycle of seasonality. We have a lot of things in play here, but that's Nashville, James. Hopefully you're online. Hopefully you saw that. I did that just for you. Oh, Jason, I see you. I just got back from Pensacola, brother. I love fishing there. This is good. Yeah. I love Pensacola. And again, man, thank you for the live chat, brother. I was going to preach not to do that, but I don't want you to lecture me. But let's look at another one, okay? Let's go into Johnny's favorite city in Boise. Johnny loves Boise. Let me start with median sales price. Okay, so this is Boise. We're going to get a little update on Boise. Because again, I heard that video from Dave Ramsey yesterday. I'm going to roast him, y'all. I'm going to roast that dude. Because, anyways. So here's Boise. Here's median sales price. So take a look at this, guys. Median sales price in Boise has year over year decline. Do you see that? Okay, it looks like Boise is now under 2021 median sales price value. Is that insane? Y'all, that's crazy. Okay, that's good. Boise's down, let's see, year over year, Boise's down 15%. Boise's crashing by my own definition, and I have exposed myself by giving definitions of a crash because a lot of people just use the narrative to flip-flop on whatever direction they want to take it to get business or views or to appear smart. I've stayed in my lane this entire time. You guys, Boise right now, median sales price is almost under 2021 value. Isn't that crazy? That's really good. That's really good. Let's look at their inventory, though. What's up? Where's Johnny at? I don't see Johnny. Dang it, Johnny. All right, let me show you guys inventory. All right, take a look at this. Now, this is why Johnny was worried. He's like, Travis, Boise. Inventory from a month of supply went under temporarily 2022. But now look, it has started going up. So hopefully the inventory increase has already started in Boise. We really don't have enough data. We don't have enough time. So we can't say it's necessarily a trend. although it appears so. This is going to be especially crippling to Boise, again, once we go into this year's cycle of normal decline. All right. So when you add the normal decline with the quantitative tightening and the breaking of fundamentals and the unaffordability, odds are median sales price is going to do what it did last year and sink. All right. It's probably going to really be bad in Boise. And you guys, that is huge loss in Boise. If you think about it, that is a massive loss. So anyone that's bought in Boise in the last 2.5 years, they're basically dead in the water as far as equity on average, right? Let's go into Austin. Let's take a look at Austin. You guys, I'm going to end it at Austin. My throat is killing me right now. And then let's see. I'm going to show you guys first median sales price in Austin. Look at Austin's almost under. You guys, okay? So Austin's been sideways. So look at the recovery rally in Austin. This is the recovery rally in Austin. It couldn't even come close to keeping pace. There was essentially like no recovery in Austin. It's pretty much, it has gone up a little, but it's pretty much completely sideways. Now it's down year over year, 18%. Austin's crashing right now. Right now, Austin's crashing. And you guys, again, when we hit the cycle, the seasonal cycle where it's normal decline, when you add all the other factors, Austin's got more room. I'm telling you right now, Austin's got more room to go down. It will go under 2021. It's already so close. It's off by $5,000. Almost under 2021, well over under 2022. So, I mean, Dave Ramsey straight up said, I was right. House prices didn't go down. Like, what's this dude talking about, man? What's this guy talking about? Months of supply. Look at this. This is what you want to see. This is what we want to see on a national level, but we're not. I have the wrong camera. Sorry. No, I have the right camera. Just looking at the wrong spot. Oh, there's Johnny. Johnny, did you get your? I went over Boise, and where's James? James, I went over Nashville. Look at this. This is what we want to see. So we had a massive run up beginning of the year, like every metro area pretty much, and then started going down, but that stopped. Thank God in March. Austin is in for some trouble. Look, it's been balanced, plateau this whole time. And there's massive amounts of new construction going up. I mean, Austin is, out of all of the metro areas that I just showed you guys, Austin has the most inventory and Austin has almost the most price decline. Obviously, Boise was like, from a year over year perspective, I'm saying like under a certain year, Boise beat Austin, not from a percentage standpoint, but do y'all see this? So, and really the reason I'm telling you guys this, I see, Johnny, it's hyper local. We can't say certainty like the housing market is completely crashing in every single metro area or rebounding in every single metro area. It has never been more important, you guys, and to use the data to find the deal, right? And understand local market is vital, especially your subdivisions. Now, obviously, rural properties won't have subdivisions, and it's a little bit harder to get data there. But generally, a property has a subdivision, and that's where I start. That's where I start, and I believe a lot of other people should start. So, anyways, you guys, that is it. Let me switch back. I think I got some super chats. Let me pull these up real quick. This is a long live. I was there on vacation just 3 weeks ago. In Pensacola, did you see any people catching sharks? I released all my sharks, you guys. Thank you, Jason. Really appreciate you. So, guys, that's it. You guys, I gotta get out of here. Drink some tea. A lot less bugs than Texas. Y'all, I had here's the thing. I'm getting some last minute stuff. Like, I love you guys. I gotta go. Like, my voice is killing me. Like, I want to help you. I do, but right now, I'm telling you, my voice is on fire. But the thing is, I gave you the data. When this is done, I'm gonna put the links in here. Please use those links to answer some of those questions. And remember, I started this out, you guys. I'm begging you guys, please, you guys. I'm begging you, use the data. You don't have to agree with my opinion. I don't care. Whether you're bullish, bearish, or you don't know what the heck is going to happen next, it doesn't matter. For the love of all that's holy, please use the data. Use those market analysis. I made this video and I started by showing even if you're a realtor, if your realtor doesn't know how to do it, have them watch this video. I just showed you how to use the data to find the deal. Please, you guys, just don't use your emotion. That's all I'm saying. Please don't use your emotion. Obviously, I'm sitting out. I told you why I'm sitting out. I think it's going to crash a lot more as far as prices. I'm pretty convinced of that. That's why I'm sitting out. Crazy thing is I only have 30 days left to find out where I'm going to live. And when you got 3 children at home, it's a hard situation. So I'm going through the stress, but data doesn't have an opinion. I know, and he's right. And that's the thing I'm trying to make. Data doesn't have an opinion. I have an opinion. You have an opinion, but the data is the data, right? Really appreciate you guys so much. You guys, I'm going to try to put out the updated foreclosure video out today. We're going to go over the health of the consumer, credit card debt. We're going to go over the delinquency for auto loans. We're going to go over the fact that an additional 200,000 households are now on the delinquency list in addition. So a lot of good stuff coming up that we're going to go over. You guys bear with me, still recovering here. And just notice my shirt. You like that? That's right. See that? I represent y'all. I'm too real, y'all. I get in trouble for being too real. But I hope that's why you guys like me. I'm super transparent. Thank you. I hope I feel better. You guys, I really appreciate you. Other than that, you guys, if you're out there investing in real estate, Bernie approved. That's funny. I hope you guys win. And I totally lost my train of thought. That thing messed me up so much. Anyways, guys, I hope you guys win.